Hello and a warm welcome to this webinar brought to you by STANLIB, where we're looking to underscore a new collaborative effort that has been highlighted previously by both STANLIB and J.P. Asset Management. As many of you might be able to tell on screen, that we certainly are taking offshore investments to new horizons. And today's conversation looks to underscore what that collaborative approach does mean, and of course, how these new horizons can be reached through new products that we'll also be discussing in terms of two funds that will offer South African investors like yourselves the opportunity not only to expand in your diversified approach to investing offshore, but also in terms of pursuing a solid return. A very good afternoon. My name is Gugule Tumfupi, and we are broadcasting to you live from a very sunny and warm Johannesburg. But I must say that given the global climate and environment that we are in, we're happy to welcome you all from all spheres of the world that you might be joining us from. Speaking of this global approach that many of us have undertaken, it must be said that many of us must be used to interacting on these kind of platforms, particularly in the last 2 years. And this does mean that this webinar is being broadcast to you live, but we will have the opportunity for you to revisit today's conversation and broadcast, as today's content will be recorded for your viewing. And in doing so, this offers you the opportunity to come back, listen back, interrogate, and understand much of the conversations that we will be sharing with you today. But as we all know, technology is not only a great connector and platform for all of us to collaborate, interact, and exchange views. It's a great friend, but it's also a fickle friend. So at any time and any point during today's broadcast, should you experience any technical difficulties, we'd like to ask you to ensure that you're able to log onto the system again and, of course, actively participate in our conversation. Ensure that you've closed off any additional tabs that might be weighing down your data connectivity. And in the worst case scenario, do be sure to double check your Wi-Fi connectivity to ensure that you're able to enjoy and continue to participate in today's broadcast. As we know, connecting through a virtual world doesn't limit the kind of interaction that we can share. And this does call for your active participation in today's conversation. Now, whilst your mics might be on mute, the Q&A and chat box service is still fully functional and operational. So we do strongly encourage you to share your questions, thoughts, and opinions with us today by actively making use of the Q&A section that is available on screen. Speaking of which, we also want you to actively drive your questions, the thoughts, and of course, get clearer understanding and messaging of the two products that we will be describing to you today. But do be mindful of the fact that you will receive further and ongoing communique at the end of today's session to provide you with more information and, of course, share more insight on the two funds that will be launched today. But I want to remind you as to why it is that we are gathered here. You might recall that last year, in the year 2021, a key and very strategic partnership was announced between STANLIB and J.P. Asset Management. Now, this does not only show the active effort to ensure that there's collaborative approaches to seeking and finding investment opportunities, but it really does underscore the power of collaboration when it comes to curating, collating, and creating investment funds that speak directly to the needs of investors like us here in South Africa. So today's conversation will look to provide some clarity on this particular partnership and, of course, share more details on the two funds that will be launched today, primarily the STANLIB Global Growth Fund and the STANLIB Global Multi-Strategy Diversified Growth Fund. And on that note, to help us understand more about this partnership, the excitement that we're going to share with you today, and of course, add more clarity as to how this collaborative approach really does provide a difference for us as South African investors, I'm joined by three guests who are with us here in studio in Johannesburg to share some insight and knowledge with us that will prove to highlight the competitive advantage of the two funds that we'll share more details on today. Gentlemen, I must say that I'm quite excited to have you all with us in studio and perhaps not being square boxes on our screens. So thank you so much, firstly, for making time to join us today. And for the benefit of our audience as well, I'd like to introduce you to our three speakers, starting to my left as we make our way down the panel. Claude Kuzo, who's the Chief Executive Officer for J.P. Asset Management Switzerland and the Head of Middle East and Africa Wholesale. Good to have you with us.
Thank you.
Thank you so much. Followed by Derek Msibi, who is the CEO of STANLIB. Good to have you with us, Derek.
Yeah, good to be here again.
Fantastic. And towards the end of the panel is Alan Errett, who's the head of STANLIB's retail distribution. Thanks for your time today, Alan.
Thanks, Gugu. Good to be here. Thank you.
Well, usually the joke is that when you do anything virtually, right, you probably have a suit and tie up on the top and no formal pants at the bottom. So I think first things first, we commend the gents for putting on full suits and full attire for today's conversation, which tells us just how seriously they're taking today's initiative. So thanks for that, gents. But I guess let's paint a picture regarding this collaborative approach. We've really emphasized the fact that this does highlight the opportunity to take offshore investments to new horizons. And Derek, many of our audience members might be actively listening and keen to understand that this partnership that was announced last year between STANLIB and J.P. Morgan, help us understand why it's been imperative for an entity like STANLIB to seek an international partner like J.P. Morgan Asset Management.
Thank you, Gugu. Thank you to everybody who's joining us today. It's really more of STANLIB responding to client needs. South African investors are looking for diversity of how their money is run. And as much as South Africa is an important market, it is a small market. And therefore, if you look at us in global terms, probably about more than 90-95% of the investable opportunities lies outside of South Africa.
Mm-hmm.
So for STANLIB, it meant that we needed to respond to that. We can respond to that by either building it ourselves or partnering. And if we're going to partner, we needed to be quite rigorous about what sort of partner we wanted to have. And once you settled on what partner you wanted to have was how do you introduce what that partner offers to the local market so that they can see the fruits of that partnership. So that's the journey that we're on, and we have settled on our relationship with J.P. Morgan. And there's a very particular reason why we chose them. Claude will elaborate a bit more on that, but the important thing is really the depth and the breadth of the capability that we believe this partnership will bring to South African investors.
Yeah, and that's quite important. Claude, perhaps this is where you can offer us further insight from a JP Morgan asset management point of view. As Derek has mentioned, many often don't look at South Africa or even the African continent as a key partner to an international organization like yours. But give us some insight. What has supported the drive and the initiative and this collaborative approach between JP Morgan Asset Management with STANLIB?
Sure. I mean, before I start, a warm and big thank you to you, Derek. I think this partnership, which is truly a knowledge partnership, so we help each other not only with product, but also with knowledge quite a lot, has been a long journey, right? So we've been working together on it since you ran 2017, right? When you ran the New York Marathon, I was in New York and we met the first time and we had the initial ideas. So it's been a long time. And I think we are all very excited that it's now here, it's coming to fruition, that we have two new products that Alan, together with us, we are launching and are able to present to South African investors really strong products, which is exciting because ultimately the objective is that South African investors can benefit from the partnership through knowledge and through products. But to your question, Gugu, I think it's similar to what you said, Derek. We are very thorough in choosing our partners. So to give you a bit of context, we have about 1 to 2 partnerships globally that JP Morgan Asset Management is launching. So it's very few. If you think about the big size of JP Morgan, it's very, very few and very selective. And South Africa has been a market that we've been looking at for quite a long time. We are very strong here with our investment bank. We haven't had a presence with asset management. And so we found with STANLIB the best possible partner with a strong brand, with strong local investment capabilities, with a very strong leadership. And combining those capabilities with our capabilities, we believe is going to be very beneficial for investors in South Africa.
Mm-hmm. And that's quite important. I also love the fact that you've elaborated that this has been a long time coming, much like the marathon that you both met at. And maybe, Derek, this gives us an opportunity to expand on the partnership and, of course, the growth that we can anticipate here. Many investors might be thinking to themselves, well, offshore is offshore. What competitive advantage does the strategic partnership offer STANLIB investors and STANLIB clients to really take full growth and advantage of the growth opportunities that might be present here?
Well, first of all, it's not just a distribution arrangement that we have with JP Morgan, it's one of knowledge sharing. And so there are a lot of developments around thinking, around how money should be run, investors understanding better what they are buying, under what cycles does it work, under what cycles that it doesn't work, and general product support on the ground around how these products are actually performing. You'll see today in the launch of the new products that you've got portfolio managers from JP Morgan on the ground being available to interact with our investors. So it's not a briefcase type of arrangement where it's fly in, fly out. This is a long term, well embedded, well rooted approach to actually servicing and making sure that people are buying products that they really understand. But more importantly, there's a very strong overlay of improving the quality of investing in South Africa and the quality of how investors understand exactly what products they're actually buying and why and whether those products are suitable to them or not. So it's not so much sales driven. It's also a combination of, yes, we want to expose the clients to new products, but at the same time, we want to improve their knowledge of the investing world.
Yeah, and that's quite important for us to understand, as you say, goes beyond just distribution, really does paint a picture in terms of the knowledge sharing and collaborative approach that takes place here. Alan, I've kept you quiet for too long. Not too sure if you were at the marathon as well, but this does contribute to, I guess, a relay of making sure that we speak to the appropriate needs of investors on the ground. As we've heard, this really does highlight the needs that investors in South Africa do need when it comes to evaluating opportunities offshore. Help us understand what particular needs you've identified from a local point of view and how it is that the J.P. Morgan Asset Management team can actually contribute to, I guess, creating this bespoke product offering that we're going to discuss later today.
Yeah, thanks, Gugu. And thanks to everyone for joining us. Do appreciate it. I think importantly, from a retail advisor perspective, we've done quite a lot of research and looked at requirements on your point in terms of needs. And there's more and more of a shift and kind of requirement for the retail advisor to potentially be investing in global or international asset managers. So the partnership with JP Morgan gives us a great opportunity, as a South African asset management business to have JP Morgan products brought to South Africa, and obviously then meet that need which advisors are wanting to look with global asset managers. And I mean, obviously JP Morgan, credentials, etc., which Claude touched on, is exceptional. So I think importantly, when bringing the product to market, we've been very clear around sticking to our strategy around simplification, because as a business, we've and I see my boss on my right nodding his head, have kind of focused on reducing our fund range where appropriate, and offering a core range of solutions to the retail market. And in terms of bringing the new product to market, that principle continues to apply. And the new funds are really around where are customer needs and where are the potential gaps in the offering within South Africa, which can complement our existing offering, but importantly, bring new product and solutions that Derek and Claude have alluded to market. And the two products we're going to chat about today are, for example, a global equity fund, which is a high conviction kind of thematic type play on a global equity proposition, which is very exciting for us to bring to market. And then a diversified multi-asset type solution, which leverages the breadth of JP Morgan's capability across different asset classes and gives our clients the opportunity to have a much more diverse type of balanced type of multi-asset solution. So we're very excited about the partnership, and as Claude and Derek have alluded to, supported by kind of information sharing, etc., which we'll take to market as well. So you're very excited.
Which is quite critical, and I think very exciting, as you say, building up the questions and the themes that many of our viewers might actually want to share in just a moment. But Claude, I'd like to come back to you on this one. As has been underscored, knowledge sharing, making sure that we're actually actively meeting the needs of investors in South Africa on the ground. We know that past performance is not an indicator of future performance, but everybody likes to evaluate the track record of the partners that we look to collaborate with. And maybe you can share some insight and paint more color to the picture regarding JP Morgan Asset Management's track record, and specifically how this does speak to the unique ability, the depth and the breadth of investment knowledge and insight that you do bring to the table, which will shape the landscape for many investors watching us today.
Very happy to talk about that. It's something that we don't need to hide, so to say. We have, as a matter of fact, we have 84% of our assets under management are above peer median. So they perform better than the average in the industry, which is a fantastic number. That's across asset class. If you look into equities, it's above 90%. So it's just like very outstanding numbers. The reason why we are there is twofold. I think some of you might have joined us for the launch event of the partnership together with Paul Bateman, who is the chairman of JP Morgan Asset Management. And he talked about the obsession that culturally the organization has with performance. So all our processes, all our investments, they're all measured against the idea, does it add and help to have better and stronger performance? And so on the basis of that, we have invested over decades a lot into our investment capabilities Today, we have about 1,000 investors, portfolio managers, and research analysts. Two of the very strong ones you will see today with Alex Stanich and with Katie Zornicraft, who manage those funds that we are launching now together with STANLIB. And so that has helped us to achieve those type of returns. I think the other element to it is also that they're global, right? I think you mentioned it, Alan, you mentioned it, Derek. So we have about 70 locations at J.P. Morgan Asset Management globally. Our investors are broadly located across the world, and we truly believe it's important to have people on the ground to understand what's going on, what's that company doing, what's that company doing, to then make a decision, is that a good investment or not? So yeah.
Exactly. Speaks to people on the ground and being very close to the investment opportunities that we're going to pursue. And of course, that knowledge sharing that was highlighted earlier. Derek, I'd like to come to you for the close of this conversation. And I guess many might be sitting thinking that this announcement really comes at a very opportune time, specifically in the South African asset management environment, where we're well aware there have been several changes. Help us understand how this collaborative effort with J.P. Morgan Asset Management will continue to impact, influence, and I guess shape some of the future outcomes and opportunities that will be present to investors going forward.
Yeah, I think at the macro industry level, we are looking at making sure that people are confident that their money is being managed professionally and to the highest standards. We believe that's important for a country like ours to mobilize savings, and we believe that by professionally and managing that money to the highest standards, we encourage a lot more people to give that money over to professionals to look after them so that they can get on with life. And we make sure that we take care of their financial wellness needs, which is why we exist. So I think that's the first thing that we would see as important. The second one is we want to open the wealth of investment opportunities that are available to South African investors. We do not underplay the importance of the local market, but we believe that over time, as the world globalizes, even as our own South African companies globalize, we need to have a way of making sure that we fully understand the investment opportunity that presents. And we've decided that we're not going to build it, we're going to partner. And we've got a partner who has got presence in geographies and in territories where we would never even dream of being able to do on our own. Mm-hmm. And the final one is really around what does it say when a top financial institution like J.P. Morgan looks at South Africa and see the opportunity. It's just a vote of confidence on both our business as STANLIB and in South Africa as a potential area for investment, long-term investing.
Certainly. What I'm certainly hearing here is underscoring the power of collaborative efforts, right? To open up new opportunities, to build up on the knowledge that can be shared. And most importantly as well, alpha is what we're in pursuit of as investors, making sure that we are able to generate a return on our investments. And I guess going back to that analogy, just very briefly, Claude, before I thank you all for joining us on stage, you've reminded us of the African proverb that if you want to go very quickly, go alone. But if you want to go far, go together. So much like the marathon that started back in 2017, showing us once again that through these collaborative efforts, this is really, really where we are able to drive a very important and collaborative change. Claude, Derek, as well as Alan, thank you so much for your time today, gentlemen. Really appreciate it.
Thank you.
Well, we know that the backdrop that has been created and set here in this conversation with our three representatives does set the theme and the tone for the investment opportunities that we can also look to explore and expand on as active participants in the South African market. But in a moment, we'll talk about the two funds that will be launched today. But as we know, many things do influence and affect our investment opportunities, specifically in the equity space. And this is where we often have to take 2 steps back just to reevaluate the macroeconomic landscape. And in the recent months, what we've witnessed is that rising inflation, the stance and positioning of central banks all speak to the opportunities that we look to pursue and might have an influence on the growth of asset classes that we might look to allocate our capital to. Well, to help us unpack and understand a clearer picture of what the expectations and outlook for the year 2022 do entail, we are joined now on the line, all the way from London, by our guest and next speaker, who is Karen Ward, J.P. Morgan Asset Management's Chief Strategist for Europe, Middle East, and Africa. Now, there is more insight and information available on Karen's bio and background, but very briefly, Karen does have a considerable amount of experience in both public policy making and economic and financial analysis. Before joining the J.P. Morgan Asset Management team in 2017, She was chair of the Council of Economic Advisors for the British Chancellor of Exchequer. So clearly someone who is well aware of the economic landscape in the continent, and of course, not only the continent, but the globe really, and will be able to elaborate further on the details and outlook that we have to be mindful of. Good to have you with us today, Karen, and thank you so much for making time. We are coming from a very sunny South Africa. I trust that the weather in London isn't disappointing today.
Oh, Gugu, you make me terribly jealous. We've been going through a horrendous storm, so I'm disappointed that I'm not joining you. Next time I'm going to be with you in person. But thank you so much for having me back. It really is a pleasure to connect with you again. It's funny, just before we came on, I said, was it 6 weeks ago that I had the opportunity to connect with STANLIB before? And I was told, no, it was in October. It just shows how time is flying. But I want to pick up on the narrative from our last session. So if we go on to, I've got some slides for you to talk through this narrative, and perhaps straight on to the summary here. When we spoke 6 weeks ago, no, of course it wasn't 6 weeks ago, as I say, it's 3 months ago. I said that inflation is the hot topic in markets. This whole question as to whether inflation was going to prove transitory or more persistent, and what the central banks were going to have to do in reaction to inflation. Well, the market has moved a long way in that story over the last 3 months. It seems pretty clear that inflation is not persistent. And the breaking news overnight, of course, is ongoing tensions between Russia and Ukraine, fueling higher energy prices. And that is feeding this concern about inflation and what the central banks will have to do about it. Ultimately, we don't think this is going to end this recovery. We don't think inflation is going to be so problematic that the central banks really have to slam on the brakes. And as we look to risk markets, to us, there still seems to be a lot of pent-up demand to come through. As the pandemic fades and people return to normal spending and normal activity, we see a lot of tailwinds to this recovery. We'll be keeping a close eye on the situation in Russia, what happens to global energy prices, but our core scenario right now is we are not at the end of this expansion. We're not near to that end point. So there's still a lot to be optimistic about. Let's unpick some of the details of this and go on to the next slide. As I say, the question when we spoke last time in October was, is this inflation problem just transitory? Is it purely the pandemic related rise in energy prices, core goods prices, as we had all those supply chain bottlenecks? And is that going to fade on its own accord? And are we going to return to a low inflation environment? That's what the market was grappling with back in the autumn of last year. And you can see that it's now increasingly clear that this inflation problem is not entirely transitory. The left-hand side chart shows you the expectations for inflation that US forecasters put together. And you can see how that peak in inflation has been consistently revised up, and the period in which inflation is expected to remain elevated is being prolonged. So inflation higher and for longer. And it's been a global phenomenon. The right-hand side chart shows, broadening out to the rest of the region, that it's also in Europe where inflation is consistently surprising to the upside. And central banks are certainly changing their tune. When we spoke, I think central banks still were using the word transitory in their communications, and that really has changed. But I don't think it's so much what's been happening to the inflation data that has led to this change of tune. It's been what's happening in the labor markets in the developed world. If we go on to the next slide, I can show you some data here. I think what's really surprising central bankers is the speed of which the labor markets have recovered and unemployment has fallen. And in fact, companies around the world are saying, we're finding it very hard to find new staff. There is a very, very tight labor market across the developed world. And the reason this is so important to the central banks is when there's a very tight labor market, workers have got bargaining power. They can ask their boss for more money in the knowledge that there aren't many workers looking to take their job. And of course, if inflation is high today, if the cost of living is rising, if workers can ask their boss for more money, that has the potential to feed a wage price inflation loop. So this is the data that the central banks are really tracking right now, what is happening in the labor market. And as I say, I think has really prompted this change of tune amongst the central banks, that this is something actually they're going to have to respond to. So we have seen a dramatic change of tone from the central banks. And in turn, we've seen a rather dramatic repricing in the bond markets. If we go over to the next slide, you can really see the extent of this repricing. So the left-hand side chart here shows you the number of rate hikes that the market is expecting this year from these big central banks. I've got the Federal Reserve on here, the ECB, and I've also put the Bank of England. And when we spoke back in October, the market was saying, okay, well, there may be a bit of tightening next year from the Fed, maybe 2 rate hikes, but they'll be very slowly beginning the process of normalization. And just look how quickly that story has changed. The market is now saying it's not going to be 2 hikes from the Fed this year. Wow, it might even be 7 hikes from the Fed. The Fed is behind the curve. They're going to have to quickly get interest rates back to some normal level. And I think it's true, and I said to you this much a few months ago, that the central banks were probably going to have to do a little bit more. They were going to have to catch up a little bit more quickly. But maybe the market's getting a little overexcited right now about quite how much the central banks are going to have to switch their foot from being hard on the accelerator towards touching the brake. I think the critical question as investors we're asking ourselves is, are the central banks so worried about inflation that they no longer are concerned about growth? Or is ultimately maintaining this recovery, maintaining growth, is that their key priority? And my belief is that they will ultimately prioritize growth. Policymakers have done so much in the last 2 years to support these economies through the pandemic. Trillions of fiscal dollars thrown at these economies to see us through. They will not now risk that. So the bond markets have dramatically repriced the short term of the interest rate curves. But maybe now we're getting to the point where actually there is a little bit too much priced, at least in the short end. The right-hand side chart I've added here just to show you that what's interesting in the bond market at the moment is that although the market is expecting the Fed to react very quickly, it doesn't actually think that those interest rates will be sustained, or that they can get interest rates significantly above 2%. In contrast to the Fed, which is saying, well, over the longer term, we think that at least 2.5% is a terminal interest rate. The market's not sure about that yet. So there could still be some further upward pressure through the course of time on longer term interest rates, particularly if it's clear that not only can the Fed normalize policy, but the ECB can actually begin the process and continue the process of normalization and get out of negative interest rates. Then that has the potential through the course of time to continue raising these longer term interest rates that we see on global bond yields. But I think the market needs to be convinced that growth will be resilient to these rising interest rates. And that's the topic that I want to turn to next, because this is where I think the market is too pessimistic, is too cynical right now about how economic growth and how markets will prove resilient in the face of rising interest rates. So let me just elaborate and show you a couple of charts which I think are so important for thinking about growth this year. This chart shows you that basically US households have done a really good job in the last 2 years of locking in the low interest rates that the Federal Reserve provided for them. US households tend to fix their mortgages for 30 years. They have very long-term interest rate structures for their mortgages. And you can see that last year, that 30-year mortgage rate that they had on offer got down to 2.7%, very low by historical standards. And that's the blue line on this chart. The gray line is the refinancing activity. So all of the people that went and refinanced their mortgages took advantage of these low interest rates. And you can just see the flurry of activity that happened when interest rates went below 3%. Now, all of those individuals that have fixed their mortgages, they're now sitting very comfortably. Whatever the Federal Reserve does, however that 10-year rises, the 30-year rises, and however that translates into mortgage costs, that might affect new housing activity. But current homeowners who've already fixed their mortgages, they've insulated themselves to rising interest costs. So that really supports their income, regardless of what the Fed does. The next chart is really important for me as I think about tailwinds to growth. You know, I think I made this point to you when I spoke 3 months ago, that I still believe there is tremendous pent-up demand. We have been stuck at home, unable to travel, to eat out, to go to hotels, enjoy all these experiences that we used to because of the pandemic. Now, we bought a lot of goods. We are still spending. We filled our homes with new furniture and television and new technology, but we actually still saved a lot of money through that period. And the left-hand side chart shows you that there is a lot of still pent-up savings, excess savings that households across the developed world are still sat on. And as it becomes, I would say, increasingly clear, certainly as from the vantage point that we have here in the UK, that we are moving from the pandemic to an endemic state where the consequences of this new variant in terms of the health outcomes are more limited and governments feel more comfortable allowing us to get back to normal without risking our health systems, then normality, life as we knew it, is finally back in sight. And therefore that pent-up demand, which I still think is significant, can finally start to be unleashed. Now, of course, higher energy prices, higher food prices, this cost of living squeeze, which we're going through, is going to eat into some of that spending. But I think it's worth keeping that pressure in proportion. The US consumer today only spends around 4% of all of their income on energy. So yes, rising gasoline prices will absorb some of that spending power, but nothing like the 70s, where energy prices were at least double digits, 15% of total consumer spending. So it takes the shine off the consumer story, but I think ultimately the tailwinds for consumer demand are still very strong. Similarly, business investment. We're hearing from businesses, there's a lot of appetite to invest. We did see in the pandemic a strong appetite to invest. Some of that may have been just coping with the pandemic and the new technologies that were required, but we still see very strong appetite amongst companies to invest. And that really is I think, globally at least, one of the big differences, that not only do we have tailwinds to consumer spending, we have tailwinds to business spending. So we have multiple engines of growth that are firing. And I think there's some real secular tailwinds to that investment story, partly because of all the new technologies that are required as we transition towards a lower carbon economy. So overall, I remain, even in the face of higher energy prices, I remain optimistic about the growth trajectory for this year. Now, of course, I will continue monitoring these higher energy prices, but that's my assessment at the current juncture. That's the developed world. Let's talk for a moment about China, because of course, China now is a very important player in the global economy and a very important impulse to global growth. And what we saw over the last 2 years is that while the developed world were really struggling with the consequences of the pandemic to the point where they were having to have enormous injections of fiscal and monetary policy, Beijing were actually tightening policy through much of the last 2 years. If we go over to the next chart, this is one of the indicators of the policy stance that we focus on in China, China's credit growth. And you can see that early in the pandemic, they were trying to increase the amount of credit flowing into the Chinese economy. But then actually over the last 18 months, they were really trying to slow things down, particularly growth in the property market. And that caused a lot of concerns last year about how they could slow the economy and whether that would lead to a larger slowdown in China, and also whether they would be able to manage or contain that slowdown. What we have seen is that not only did they manage that slowdown well, but now they are sufficiently comfortable with taking their foot off the brake and applying their foot back to the accelerator. So quite a contrast to that story that I was telling you in the Western economies, where central banks now are moving from the accelerator to the brake. So China, which was a big underperformer in global markets last year, we're seeing the opportunities now as Beijing focuses on stimulating growth, increasing the expansion, and that will in turn support global growth and I think global sentiment as we move through the course of the year. We move to a more synchronized global recovery. So economic growth, I believe, going through the course of the year, has significant tailwinds. Pent-up consumer demand as Omicron fades, businesses spending in new technologies and particularly climate technologies, and that being a tailwind to growth, as well as China, a very important source of demand for broader emerging markets, including South Africa, also adding to global growth this year. And that then provides me the building blocks for as I start to think about risk markets and I start to think about stocks, because ultimately what we care about is the trajectory for corporate earnings. As long as expectations for corporate earnings are still rising, then equity markets will be able to withstand central banks easing off the accelerator, removing their monetary stimulus. We've seen this many times in the past, that as long as central banks are removing stimulus, but growth is sound and robust, then equity markets can still move higher. So the next chart is the key one that I'm keeping my eye on, which are earnings expectations. Now I call this my worms chart, and I hope from looking at it, you can see why it gets that name. These are the expectations for earnings for the S&P, but I track these data for every single region for each of the coming quarters. And what you can see is that, let's take the gray line, for example. This was expectations for the earnings quarter that we're just concluding, Q4 of last year. We're just concluding this earnings quarter. Companies are telling us how they did in this quarter, giving us some guidance for the future. And you can see that we came into that quarter with overall earnings per share around about $51. But as we moved through that earnings season, that was progressively revised up, and overall it looks like we're settling up more like $55 earnings per share for the S&P as a whole. And just as importantly, there wasn't anything in the guidance which has made analysts think about wanting to take down some of their expectations for later quarters. So particularly for Q3, the purple line, or the green line, Q4 of this year, those generally are continuing to move up. So what we're hearing from companies is that demand is robust, that actually, even though they are experiencing cost pressures, even though they are experiencing rising energy prices, rising wage costs, they're passing them on, they're maintaining their margins on aggregate, and therefore earnings are proving resilient. And as long as we keep getting that message from companies, then I think my worms keep moving uphill, and overall risk markets will prove resilient and have scope to move higher through the course of the year. And ultimately, on the next slide, thinking about all the different regions, and again, I'm thinking about corporate earnings this year and what the market is currently expecting, it doesn't look like a very high bar to beat. So again, let me talk you through what this chart is. The green lines are overall earnings expectations for this year for each of the different regions. And then just to set that into some context, the gray bars are what the earnings were delivered through much of the last cycle, in the normal period of the last cycle. And you can see that in most regions, earnings expectations for this year aren't particularly above what you might consider to be normal expectations. The UK is a different one here because of the mix, energy, and what's happening in global oil prices is a key part of that story. But overall, if I think about the US, if I think about China, if I think about the emerging world, then actually I don't think these earnings expectations are particularly demanding. I think the likelihood is we will see those expectations being revised up. We'll see those worms keep moving up, pushing these expectations up, and therefore that provides the tailwind overall for risk markets. So, as I say, the key risk here is what's happening in Russia and Ukraine. And I don't want to downplay entirely the risk that that poses. It is true that if we see oil prices move to $120, $150, as well as perhaps some of the consequences for broader commodities. Russia is a very important producer, not only of oil and natural gas, but actually of fertilizers, for example, and therefore the role that plays in global food prices. So we absolutely shouldn't be complacent at this point in time. We will be watching, but because of that dependency of the world economy, we think there is extreme incentive and emphasis on negotiating a way through a diplomatic solution in the coming days and weeks. And therefore that tail risk scenario doesn't derail the whole story that I've outlined today. But we will be tracking that risk very closely. But for now, let me just come back to the conclusions of how we see the world today. Inflation is still going to remain a top topic of conversation. Hopefully, when I come and visit you in South Africa and see your beautiful country and enjoy your lovely weather, I'm sure we're still going to be talking about inflation. And although I don't think it is going to be transitory, I also don't think it's out of control. I think the central banks will have to raise interest rates, but I don't think they're going to have to slam on the brakes, force a recession to get rid of it. I think they will be able to remove stimulus gradually in a way that's not disruptive. And ultimately, I think the tailwinds to the expansion, pent-up demand, consumers who have savings, whose house prices have gone up double digits over the last couple of years, whose pension is looking pretty good because of global markets, that supports consumer spending as life returns to normality, and ultimately growth proves resilient to both higher energy prices and modestly higher interest rates. And therefore we go through the coming quarters with companies still guiding us that earnings are robust, They are guiding us towards higher earnings expectations. And therefore, despite what will undoubtedly be a more volatile year than what we have experienced through the course of last year, that we will see risk markets supported because of that strength of underlying activity. But we will be monitoring, of course, the situation between Russia and the Ukraine to ensure that that story is not being derailed. But our judgment at the moment is that that was a key tail risk for us to monitor. It doesn't yet derail what is our core expectation for the year. So I'm going to pause there. And I think we've got some time for questions. And I think, Gugu, you're going to lead us through that.
Certainly. Karen, thank you so much for such an insightful presentation and really setting the tone and the themes that we do need to be cognizant of. And quite refreshing that you have touched on many of the risk factors that we need to be aware of. There was a question on the line about the economic ramifications and the fallout, given the conflict that we see between Russia and the Ukraine. But I guess, as you've mentioned, it is something that we will continue to monitor, but does not change the outlook and trajectory for the moment. But as we talk about this, Karen, I guess reflecting and reviewing the opportunities that persist, we are well aware that the last 2 years have seen a lot of volatility when it comes to the equity market space. They've influenced investment decisions, and of course, we've seen various levels of performances in certain sectors which were once considered to be alive with lots of growth, prospects, and opportunity. So I'm keen to understand from you, you've already highlighted the concerns regarding rising inflation, the stance of central banks, what we do see in terms of geopolitics. If there are any other key risks and threats to earnings growth for companies, and of course the performance of the equities market overall in terms of the global scenario that we're playing with at the moment.
I think the key thing, Gugu, is I think about how performance over the coming year, but also the coming cycle perhaps, could differ from the past. And the thing I would really caution investors against is relying too heavily on market leadership over the last 2 years, or indeed the last cycle. You know, we saw through the last cycle that the US heavily dominated market performance, and particularly that was due to the presence of some very large technology stocks. And although that's absolutely a secular theme that we think remains very important, things like cloud computing, artificial intelligence, there's a really secular earnings story there. However, the low interest rate environment where in the last cycle we were stuck in this inflation environment that was too low, that did, I think, compound that market leadership that we saw. As we go forward, if I'm right, and we're moving towards a modestly higher inflation and interest rate regime, that can influence the market leadership. And as you say, Gugu, what we've seen over the course of the year before Russia and Ukraine was top of our news feed was how we were seeing the markets rotate away from former leaders, technology, and the NASDAQ towards some other segments of the market, the more value-based areas of the market, and how therefore that market leadership was broadening. And I think that's a really critical opportunity for us to think about. I think that we will see the returns from here broaden away from the US and dominated by a few names and a few stocks, really broadening to opportunities that are more geographically dispersed and also by sector.
A phenomenal part to leave it off on, because that really does provide a lot more options and opportunities for us as investors to tap into, as you say, looking very vastly at the opportunities right across the globe. Thank you so much for your time today, Karen. Unfortunately, we have to pause it just there. But as you say, there's a lot for us to absorb and underscore in terms of the macroeconomic climate and the role and influence that it does play within our investment decisions. Thank you once again for your time, Karen. Really appreciate it. And as you mentioned, as soon as you make your way to sunny South Africa, we'll be happy to welcome you with warm arms.
I'll be getting my ticket straight away.
Fantastic. Well, that was Karen giving us some insight into the outlook that we have for the remainder of the year. And one thing is quite evident, right, is the fact that volatility remains. And it is something that we are quite adept with and understand does play a significant influence in the investment environment and climate. And this also speaks to the kind of input that it does have if it comes to the two portfolios that we're discussing today and their launches, specifically being the STANLIB Global Growth Fund, as well as the STANLIB Global Multi-Strategy Diversified Growth Fund. These are all the considerations that needed to be applied into the minds of the individuals who sit on the other side, constructing these portfolios, positioning them, and of course, keeping in mind the many themes that, as Karen has already highlighted in her opening and introductory phase. And I think this really helps us shift gears now. We understand why the partnership between STANLIB and J.P. Morgan Asset Management is critical. We're fully aware of the ongoing risks and volatile environment that we operate in from a global perspective. But how does this feed and fuel into the investment decisions that we are making and taking by investing primarily in these two funds that are being launched here today? Well, in studio and online, I'm joined by three speakers who will be giving us further clarity and insight. In other words, we're getting into the minds of the individuals who sat back and evaluated these portfolios and how it is that they are constructed. So in studio, I'd like to warmly welcome Marius Oberhoser, who joins us in studio, and of course, not forgetting Alex Stanek, who also both join us to give us some more insight into this conversation. And virtually, we will also be joined by Katie Thornycroft to add to the conversation and help us fully understand and seek exposure and clarity on these particular portfolios and how they have been constructed. We'd like to start off though with the STANLIB Global Growth Fund. And this really adds some clarity into understanding the opportunities that exist, how this particular portfolio has been constructed and positioned, and how it also speaks to major themes that we as investors are quite cognizant of, particularly when it comes to ESG and sustainability. So these are a few of the themes that Alex will give us some insight into through this next presentation. And if you have been wondering as to where your money is going, what underscores the success of these two funds, this is the part of the conversation where you need to be taking notes. So Alex, as I hand over to you to give us some further clarity and insight into this conversation, happy for you to paint more color and clarity to the STANLIB Global Growth Fund.
Great, thank you very much for that introduction. And obviously, unlike Karen, I'm actually here, so it's a fantastic environment to be in, leaving the stormy UK behind. So first of all, thank you for your attention. And what I've proposed to do today is to talk you through our approach to investing on a global basis, looking for higher growth quality companies on a global basis. So trying to level set and set the agenda in terms of how we go about investing. Global is a very wide universe with a tremendous amount of opportunities, but you need a very robust approach to do this. Our approach is really starting on this page, and it gives you a good overview of how we think about investing more broadly. The first point, and you might expect me to say this being a global fund manager, is that a global perspective is really, really important. You've heard some references to that already. Every country has its own domestic importance, but on a global basis, there's a ton of opportunities which you might not be able to take advantage of in your domestic market. In order to find those opportunities, the global perspective is really about context and reach. So reach, we can find where those best opportunities are to invest in, wherever they are located. Context, each of those ideas has to compete for capital. It has to be better than the others out there, all of them. And so that is a severe hurdle rate, which we imposed deliberately on stock selection. But of course, it's a very wide remit. So how do we go about focusing our research efforts on things that will work and we believe will drive superior returns over the long term? The first critical point in this slide after that global perspective is we look for structural growth. The obvious question would be why? Well, our calculations show that over the long term, earnings growth drives the majority of shareholder returns. It drives performance. So what we're looking for very clearly is for companies which can deliver sustainable earnings growth, but over the long term. This isn't just a 1-2 year trick. This is looking for companies which can grow at a superior level for many years. You might be aware that about 90% of stocks tend to mean revert. They fade. That growth fades quickly. So immediately, you can think we're looking at a subset of the overall universe, maybe 10%, and within that, we finesse it further. Because growth on its own isn't enough. We also look for quality criteria. And a little bit more of that later on, but initially, just to give you an overview, that helps to ensure the ability we get that growth delivered to us as shareholders and obviously for our unit holders. So not only is it a way of guaranteeing that growth, it actually effectively lowers the risk profile. A lot of our companies are net cash. So when you have an outcome like the pandemic situation, when it kicked in a major situation in March 2020, our companies could invest through that and drive that growth to the long term, which is a huge competitive advantage. But of course, things that are good can be expensive. So what we're looking to do is provide a strong investment return. This is the fourth point in this chart. We think that combination of strong, resilient earnings growth through many years, driven by a high returning, conservatively financed business, can lead to strong value creation. It's what we call value creative growth. It's where the returns are in excess of the cost of capital and sequential growth over many years delivers substantial value. So what we do is we model that and we look to find where that's mispriced. And if it is, the hurdle rate for a stock getting into the strategy is we expect it to double on a 5-year view. If you break that down, that's about 14.5% per annum. So we're deliberately setting the hurdle rate pretty high. Final aspect on here, and it's become a very important part of the investment landscape, is how we deal with ESG, environmental, social, and governance. In summary, you can think of it as a positive reinforcer to the prior points. In terms of structural growth, the environmental trends we're trying to invest in tend to be on the positive side, not the negative side of the environmental equation. The same with social constructs. The G aspect is something we've been doing for a very long time. We want to make sure that our unit holders and us as shareholders are protected in terms of the ability to derive a benefit from providing capital for a company and getting a benefit from that. So it's always been part of the equation. Overall, if you're going to remember one thing, it's that we invest in value creative growth. The next question would be, where do we find that growth? On this slide, we have 5 groupings of themes. Now, what really these boil down to is it's a construct to identify where that long-term growth potential can come from. We look for empirical evidence, real world trends. This isn't future gazing and expecting some incredible things to happen in 20 years' time. This is what's happening now and has been happening for some time. They form 2 functions, and this is nicely summarized by a Bill Gates quote, which was the market tends to overestimate, people tend to overestimate what happens in the next 2 years, and majorly, that's my addition, underestimate what happens in the next 10. And so what the themes are doing, they're first of all pivoting us towards long-term growth trends, but they're also stretching our time horizon. And that is an important aspect. It takes us out of the typical and classic macroeconomic cycle. Companies can work straight through that and out the other side. There's a selection here of quite diversified growth drivers. I don't propose to go through them all right now, although I'd love to at maybe a separate time, but they include things like the digital economy, digital revolution. To quote the new CEO of Microsoft, Satya Nadella, every company is going digital. This was happening pre-pandemic. It was a strong investable trend before pandemic. The pandemic has really focused corporate attention on this. You have to do it just to survive. This is a very investable trend, and many of the companies we look at are strong beneficiaries of this and actually helping to provide the tools to do that. You can also look at the going green theme. We're all aware of the challenges of the environment. We're looking at the move towards electric vehicles driven by consumer choice, as well as the regulatory environment. So again, we look for the best part in the value chain to invest there to drive the sustainable returns at the right price with the right level of quality. We tend to observe that over the long term, themes are inefficiently valued by the market. They get fashionable from time to time, but actually in the background, whether unfashionable or fashionable, they keep working away and behind the scenes effectively. And that is important to how we think about investing. So I talked a little bit about growth. Now let's focus on quality and the combination of quality and growth. You can see from this chart, we've got an example of a company called Estee Lauder. It shouldn't need much of an introduction. It's one of the world's leading cosmetics businesses. This is the time series chart looking at what happened between 2002 and 2019, which is quite a mixed environment in terms of the background, the macroeconomic background, the market background, whether value or growth worked, and all those exciting cyclical rotations. And what you tend to notice from the metrics in this chart are a couple of things. First of all, the average P has always been a bit of a premium to the market. It's about 5 to 7 points higher than the S&P on average. It varies a little bit, but it tends to be higher. Behind that, organic sales growth has come in and been positive every single year apart from the financial crisis. That's a pretty impressive resilience to a business. On top of that, the operating profit margin barely dipped compared to other businesses. Over this period, the shares outperformed the S&P by almost 3 times, revenues grew by 3 times, and the earnings base grew by 12 times. This business compounded up, delivered very strong returns, And that's against the S&P, which, as Karen mentioned earlier, was one of the best performing markets on the planet over this period. So you can see that combination of successive sequential growth with a good quality franchise and enduring resilient business is the sort of thing we really try and look for, either already happening or we think can happen to a company. So I guess the key question is, how do we go about this? It's a big universe, it's a big environment. How do we filter and focus our stock selection down to sort of hard kernel of ideas? We're big believers in deep fundamental research. It's increasing importance with the stresses on the market to have deep insight to those individual companies, which is driven by your agenda, not buying someone else's research or renting it out from another firm, driven by your agenda, the agenda we choose for our client base on a 5-year view. That's very different to the sell side by reference. The way we construct the approach to research is we have a large base of regional analysts. There are about 90, they cover 2,500 stocks. But we focus that and filter that down to tech and sector specialists whose remit is to look purely globally, purely opportunistically. They have a deep bench of experience, 21 years on average, so high level dialogue with the corporate management teams to really understand the strategy behind the company. I'm joined by my co-founder manager, Caroline Keane, who we've had about 10 years of overlap of previous work experience working together. She sadly can't be here today, but I suspect she'll be seeing her in the future. The research base is very powerful. We can go anywhere, we can move very quickly, but we have that global focus. And that whittles down the stock section very, very quickly. This is a schematic on that fact. So the starting point is looking for those broad structural growth themes. The sector specialists focus in. They look for quality and growth analysis. They do a lot of work there to drive that valuation framework to determine whether the stock can generate that 14.5% per annum minimum return. At the portfolio manager level, they communicate to those ideas to us. And there's basically competition for capital to get from the strategy. We run 30 to 50 stocks. It's focused, but it's also diversified. What makes the cut is on this chart. So I've talked about growth, I've talked about quality, and I've talked about that total shareholder return. We're looking for the overlap between those three criteria. We're looking for structural growth, ability to beat the fade, value creative growth. We're looking for a strong franchise, strong market position, strong financial strength, a strong balance sheet, net cash ideally. ESG is a positive reinforcer, and of course that shareholder return. As you can imagine, there aren't that many businesses which qualify. This slide breaks that into a little bit more detail. And I suppose at a high level, you can see some of the things we look at in terms of determining franchise strength, some of the things we look for in terms of competitive moat, the financial aspect. Talked about low gearing. We look at a premium of return over the cost of capital, a sustainable or growing one, sustainable or growing margins. That's just some quality. And that's just a snapshot or a very short list of things we really do look at over time. Spend a lot of our time focusing on those. Growth, what type of growth? Is it structural? How much is actually really cyclical? Is it visible? Is it recurring? What percentage of the business is on a recurring revenue construct? So we analyze that. We also look at that excess return we want to try and generate. Is the TSR in excess of 100%? What's the driver of that? We tend to focus on earnings being the driver, not a sort of valuation or revaluation case. We're looking for the earnings to do the heavy lifting. A little bit more detail on ESG, and I think probably the key points in this slide is to draw out that it's integrated within our research. We also take on market-wide rating views. So we look at MSCI data, but critically, we're critical users of that. There's some businesses where we strongly disagree with the ratings, and we put a very strong case together for that and explain why to our clients. And we think there'll be a rate of improvement, which is not captured by those metrics. We have a strong internal team as well who do this separately, and we actively monitor the impact at the portfolio level. Talking about portfolios, what does the strategy look like at the moment? Starting with my favorite slide, this is looking at strategy characteristics as if the strategy was a stock, which I think is a plain vanilla way of saying, are we doing what we're doing? And we look at 4 areas here. First of all, in terms of long-term earnings growth, the expected earnings growth on a compounded annual basis for companies in the fund is about just under 20%. If you think about the metrics there, that compounds up to a pretty substantial creation of an earnings base and is in some premium to what you'd expect from, let's say, the index, which is here we've used the MSCI ACWI growth. So as those returns, and this is looking at return on invested capital. The return for the companies we own is about 21.4%, compares again favorably to the index at about 19, which actually in itself is a good level of return. The next point about this, the quality aspect in another way, and a more defensive version of things. Looking at the balance sheet, one great metric that we spend a lot of time thinking about is net debt to equity, the amount of financial leverage in the business, which means that it has added resilience on top of those returns. You can see from this metric, our companies are net cash. They don't have net debt. And that is in stark contrast to the index, which is sitting at about 24%, which is, I think, is actually a surprisingly high level. It's a risk we can dial down and dial out. We do not need to take this risk to generate the returns we're looking for. The final part on valuation, this is on consensus numbers. Our strategy, the stocks look pretty good value versus the market. They're about in line. They were a little bit low. On different metrics, we're a little bit above, a little bit below. We're not so focused on this. But actually, frankly, with the characteristics I've already described, we'd be happy to pay a little bit of a premium on spot multiples of the stocks we own. We think it's deserved. On those stocks, we have the top 10 active positions here. And you can see relative degree of focus, but also there's some diversification across those long-term growth drivers. So within the idea of being an unconstrained fund, that we all just want like a mono-sector bet or a mono-country bet. And actually what you find when you go down to the stock level is there are multiple drivers behind these stock names. What drives the business at MasterCard is very, very different to what drives it at IDP Education, which is very different which what drives it at MSCI or even Cadence Design Systems. And that is the core, looking for a resilient, diversified growth portfolio, which drives long-term performance through earnings. Just very quick, in one example, IDP Education is perhaps a little bit less well known than the other names on that list. It's an Australian business which runs English language testing for sort of the students and migrants who want to move to different countries. There's tremendous demand for this qualification, and it's like a blue chip qualification to get to enable you to move. There's lots of demand. There's also lots of demand from students, lots of demand for universities. Universities in the UK get paid more to accept overseas students. So it's a twin network benefit. It's effectively a duopoly. So the business earns very strong returns, has a great growth rate. And in the crisis, they reinvested aggressively to re-optimize their operating system and digitalize a lot of their business. So their operating efficiencies are much, much higher now coming out of the crisis than they were going in. So it's a sort of business that really stands out as a unique franchise, drawing great returns, great growth for the long term, and driven by something a little bit different to the classic macro cycle. Now we get the sector and country positions. You can see how a little bit of a leaning towards North America and a bit of a focus in information technology. It's important to break that down. So on the next page, we look at the actual breakdown at the subsector level. And what you can see from this chart is relatively clear. On the right-hand side of that chart, there are sectors which just don't qualify. The stocks don't meet our requirements. So in some insurance businesses, some energy businesses, they're not capable of generating returns and growth we're looking for that are competitive with other businesses we own. On the left-hand side, where we concentrate our investments. So in software and services, you'll be surprised to learn that actually the bulk of that weighting is in payments companies, which I don't really think of as tech. We don't think of as tech. They're not driven by a tech cycle, but they're driven by the long-term growth in financial services and on an electronic basis. So again, you can see we're very disciplined in terms of what we will own and what we won't own. Overall, as people mentioned, the markets have been pretty volatile, actually. We've had some good absolute returns, but we also had some good relative returns, especially in 2020, where a lot of the trends we've been investing in for a long time really intensified, and the shares were rewarded as much as what we owned did well and what we didn't own did badly. We've given some of that back in the short term over the last part of last year, as we've had this growth rotation. And one thing that's interesting from that is a lot of businesses needed to sell off ones that we didn't own. There were high multiples, we couldn't justify the valuations. And unfortunately, that's dragged down some of our stocks where the fundamentals have done nothing but get better. So the prices have got more attractive, which again is how you build long-term returns. So some of that is actually healthy, as painful as it may have been. So maybe in summary, if you had 3 points to kind of hold on to, we have a quality growth approach to investing. We're looking for businesses that are either generating high returns now or can do in the future, and growth which will succeed the macro cycle. We have a high conviction portfolio of only 30 to 50 names. We typically only have a tighter set. It's 35 to 40 is where we typically sit. And there's a high level of competition for stocks to get in this fund, deliberately so. And I'd like to just remind everyone, we have a very substantial global research team, which is tremendously important when you're navigating difficult markets, looking to have conviction in those fundamentals, and really take advantage of the opportunities as they come about. And We have quite a lot of experience. I've been in this for a reasonable amount of time now, almost too long, but the analysts also have over 20 years experience as some of the fund managers do. So there's a lot of seasoned experience within this team. But that's the end of my formal comments. So maybe I'll just pause there and see if there are any questions.
Indeed. Thanks so much for that, Alex. And I think very informative for many of us to get clarity and context into where and how it is that the STANLIB Global Growth Fund is positioned. I don't think you've been in the business too long. You can never gain too much experience in the world in the realm of investments, given the ongoing changes and volatility that we witness. But a key question that has come through from one of our audience members pertains to your team. And as you mentioned earlier, at least 90 research analysts positioned all over the globe, and in your concluding remarks as well, emphasizing that this does play a strong influence in your investment decisions that you take. I can just imagine working with different mindsets located in different areas around the world, that you must hear very different opinions. Help us understand how you balance and offset, I guess, some of the varying strategies and thought processes that actually might apply to making sure that you do keep with the investment mandate of the Global Growth Fund.
Yeah, that's a great question. So essentially, we have a situation where we have a wealth of research, which is fantastic, and it's very important to looking at potential ideas or managing existing ideas. So there's a lot of research which goes on, but of course, if you have too much information, you can have information overload. There's too much. It's a wall of info. How do you deal with it? How do you make sense of it? And this is where two things come to pass. One is the focus of the investment approach itself. So looking for a very select group of companies, which rules out a lot of that noise. We don't have to have that dialogue. The second aspect is having the global sector specialists. So they form a conduit between us as PMs and the wide research resource. And of course, we can bypass that to add to a conversation, but really they're a very good funnel for having those debates. They provide great context to the local analysts, but we get great contextualization and detail back from those local teams. So if you think about it as a sort of pyramid where you have a breadth of information, we filter that by our approach, we filter that by the personnel, and that experience is important. So you don't chase down false leads, for example. You know the business, you know the cycle. And that comes to a pinnacle or a point to the PM team, which is myself and Caroline. And we have, it's important to reinforce this, we have a very strong discipline in terms of the process. If a company just doesn't pass muster, we do not invest in it. That's it. There's no wiggle room, there's no margin for error. That's the way it is. And some of those sectors, which we've highlighted earlier on, it's possible, but we haven't seen that. So we don't invest. We don't chase them if they're doing well for a period of time. We look for opportunities on the other side to build those long-term returns.
Which is quite critical. And as we've witnessed, that's exactly what we're looking for in terms of the mandate of this particular portfolio. Alex, thank you so much. We'll have to pause it there for just a moment because there's lots of excitement and I guess a buzz to expand on the understanding of both these particular portfolios. But Alex will stay with us, and a reminder that he does fulfill the role as portfolio manager in the J.P. Morgan Asset Management International Equity Group based in London. So very important that we have full clarity and an understanding of the Global Growth Fund. But of course, there's another product that has also been launched here today that we seek clarity on, and that's STANLIB's Global's Multi-Strategy Diversified Growth Fund. And to help us understand the contrast between these two particular funds, again, its positioning and some of the key characteristics that do speak to the ongoing pursuit of alpha that we seek, we're going to be joined again by two guests who will provide us with some clarity and insight into this positioning in quite an interactive session once again. Marius Oberholzer joins us as STANLIB's head of multi-strategy. He'll introduce STANLIB's new Global Multi-Strategy Diversified Growth Fund. But he's not alone, as has been underscored throughout the whole morning and session for today, is that it's all about the power of collaboration. And that does mean that we will be joined as well by Katie Thorncroft. Katie is the lead for J.P. Morgan Asset Management Multi-Asset Solutions International Portfolio Management Team. And together, they'll be sharing some insight with us to fully grasp an understanding of this particular portfolio. And of course, the fund being STANLIB's Global Multi-Strategy Diversified Growth Fund. Well, I'm looking forward to this one. And again, I guess helps us evaluate and understand and see how this collaborative effort does take place. And Marius, I'm quite excited. I can imagine that there've been many calls, many engagements with yourself and Katie to further underscore and elaborate the importance of this particular fund.
Yeah, thanks, Gugu. And good afternoon, everybody. Gugu mentioned it a few times. It's an exciting day for us. And this is really the culmination of 2.5 to 3 years of work for my team based in South Africa and Katie's team sitting in London, where we've really sat back and thought carefully around how we can design a strategy, a portfolio mix that will solve a South African investor's real long-term thinking about driving returns within the global landscape, which is changing dramatically. And certainly our viewpoint was that there would be change going forward. Balanced funds have done a phenomenal job for investors over the long term, but with the compression of rates, we've seen an increased return from equities and potentially rates not acting as a ballast as they have as we move into a more volatile world as interest rates naturally rise from these very low levels that they've sat at. So as the team sat together, we really wanted to think carefully around designing a strategy that could be utilized as a core building block or something really to provide an anchor for during these uncertain times. And I think we've done that. We've really leaned heavily on J.P. Morgan Asset Management's deep-rooted research capabilities as they design long-term portfolios, really anchoring on their long-term capital market assumptions. And I think we've heard a number of J.P. Morgan Asset Management people talking around their process in terms of forecasting those returns on a 10-year view. And Katie and her team really helped us distill that information to design a portfolio, as I said, that we think can be a core component to a wider portfolio, a total solution, or a core portfolio. Important for us were a couple of things. We wanted to work with a team that was pretty dynamic in their thinking, that didn't just think around asset class adjustments, but also within asset classes, and wasn't specifically deploying capital into one specific style, but was really able to deploy across a really wide spectrum of asset classes, strategies, and investment styles to create this really robust portfolio, and a portfolio that people can sleep well at night with, given low levels of volatility relative to a pure equity portfolio. And again, I'm going to pass over to Katie in a second, but I think it's important to keep in mind that this is a longer term solution. We are looking to provide a very specific outcome at the end of a medium term environment, a medium term outlook of 3 to 5 years. And so we're really agnostic to what the peer group does. We are really looking to provide that defined outcome, high degree of predictability and low volatility. And with that, I guess I'm going to pass over to Katie in London, but for the first time, I'd like to say, Katie, over to you, my colleague in London.
Thank you so much, Marius. It's been an absolute pleasure working with you over the last couple of years to design this strategy, and I'm so excited to be here today for the launch. So if we move on to the slides, please. I'm going to give you the details of the way that we've constructed this portfolio, what the goals are, and also give you an update in terms of our current themes and the positioning of this portfolio. It is the STANLIB Global Multi-Strategy Diversified Growth Fund. Next slide. We are managing this portfolio in a dynamic and flexible way. It is well diversified, as we've discussed, it's multi-asset, and we're really aiming for those medium-term goals to be able to outperform US inflation by 5%. And we want to do that with a careful eye on risk. And you can see on this slide that we're looking to have returns with a CPI plus 5%, but with volatility of between 10 and 12%. Gareth, Joe and I, the portfolio managers, we're part of the J.P. Morgan Asset Management Solutions business. We are a global multi-asset team, and we manage $300 billion across multi-asset mandates. The outcome-oriented portfolio here has been designed specifically to be that core investment solution that Marius described. It is incredibly well diversified across asset classes, within asset classes, and importantly, different styles of underlying strategies. Next slide. I've included here what's possibly the most simple slide to explain to you why we absolutely love diversification within our portfolios. What you can see on the left-hand side is a grey bar showing the range of returns for US equities over a one-year period. This is a rolling one-year period. The blue bar is showing the same for US bonds, and the green bar is showing the same for a 50-50 mix of US equities and bonds. And what we're really trying to illustrate here is that if you remain invested for the long term, what you can see is the power of diversification, the power of long-term returns comes through. Because over 1 year, looking at that green bar, you might have been lucky enough to receive a return of 49% over a rolling one-year period. but it could have been a loss of minus 24%. But look at that 10-year block of data. Over a 10-year period, what you can see is that there wasn't a 1-year rolling, or there wasn't a 10-year period where you received negative returns from that mix of equities and bonds. So that's simple US equities and bonds. Now take that a step further and think about diversification as being across asset classes, within asset classes, and importantly, across alpha sources as well. And then you're really getting to the heart of how we manage our portfolios. Next slide. So I really want to be able to share to you what our investment philosophy is all about and some more details on our process. So if we move forward, what we are looking forward to is generating long-term capital growth by investing across asset classes. And we are using the 3 key principles that you can see on this slide in order to do that. So on the left-hand side, of course, we have a structured and disciplined investment process. We are supported very much by dedicated multi-asset research capabilities sitting within our team. We've got more than 20 people that are supporting the portfolio managers in terms of that multi-asset research. That's a real differentiator for us as a multi-asset business. They've got a wide range of skills. We've got everything from quantitative finance PhDs through to experienced economists. And that's really invaluable for us as we're deciding what those key themes are driving portfolios and which positions to take. In the middle, we are very much dynamic and diversified, and we want to have a broad opportunity set with which to reflect those tools. I think this is a really important part about how we smooth returns through time. And then on the right-hand side, the other key principle about our investment approach is really being able to leverage the broader J.P. Morgan asset management platform. This is a $2 trillion plus investment platform. We've got more than 500 strategies from which we can select. That really, again, adds that extra level of diversification and choice into our multi-asset mandate. So our investment philosophy is very much centered on that dedicated multi-asset research, which is driving our investment process. It's centered on having a flexible and dynamic approach to investing in markets. And it's also leveraging that investment platform and capabilities that we have across the broader organization. So how do we bring this all together to be able to generate returns greater than inflation through time? So we're looking for that US CPI plus 5% return. And even before we get to the portfolio construction that you can see on the left-hand side here, we need to think about which asset classes over the long term are going to get us most of the way there to that return goal, and to be able to do that with reasonable levels of volatility. And that's where we're using our proprietary long-term capital market assumptions that Marius referenced to help us create the strategic framework. Now, these assumptions are 10 to 15-year forward-looking return and volatility assumptions, as well as correlations across different asset classes and different currencies. And that really provides a base for our portfolios. Now, this publication is actually available to clients. It's very well valued by clients as well. We're in our 26th year of this, but we eat our own cooking here. And the fact that we use these in our portfolios really means that we're providing that stable base of a strategic framework through time. So then, once we've got that strategic framework, now if we look at the slide, we can think about the other parts of portfolio construction. So I've mentioned the breadth and depth of the J.P. Morgan Asset Management investment platform. When it comes to the strategy selection, we really want to be able to benefit from the different ways and different styles of managing money. We want to be able to put together investment strategies that give us a diversified source of alpha as well as beta within the portfolio. That helps provide a smoother return base as we look forward. And you can see on the right-hand side where we've got the globes at the top there, some of the breadth and depth of strategies that are available to us. So it could be large cap and small cap. It could be different styles of investing within fixed income, government bonds, credit, high yield, and so on. So we've got a great range of strategies. And then on the left again, the light blue, active asset allocation. This is really the core of what we do. And when we talk about being dynamic and flexible, this is what we mean. We want to be able to take opportunities within markets and generate alpha from active asset allocation. I'll show you a little bit more about this in a moment, but finally on risk management, this is fully integrated into what we do. It is integrated into how we size positions, given our view and conviction, but it's also about how do we manage that overall account volatility and mitigate drawdowns. And again, I'll show you a little bit more on that. Next slide. So here we're illustrating more details about, okay, I say that we're flexible, we're dynamic. How do we take those decisions? In the middle of this chart, you can see that we start with establishing what are the key macroeconomic themes that we want to reflect in portfolios through time. How do we think about that? Well, we draw on that dedicated multi-asset research that I referenced. So in the top left, fundamental research. We want to establish what do we think the base case views are for the outlook for growth, for inflation, for monetary policy, for central bank behavior. Once we've got that framework in place, we can then start to think about which asset allocation decisions we want to take within that. And again, we're supported by our dedicated multi-asset research, both qualitative and in the middle, quantitative signals. We have quantitative models which are directional, which are relative value. And this information, again, helps us as portfolio managers establish where to take risk in the portfolio. And then on the right-hand side at the top, we also care about the bottom-up insights we're getting from our asset class specialists. It can help us frame our macroeconomic themes, but it also helps inform where we want to actually implement some of these views. So putting all of this together, in terms of the way we take the decisions, we then need to decide where are we going to reflect these views? How much equity do we want in portfolios? If we want equity, where do we want to lean in? Where do we want to lean away from? Which styles do we want to lean towards and away from? In fixed income, what about levels of government bond risk? We know that that has been a bit of a challenge over recent months. What about credit? Do we think those credit spreads really sort of give us the returns that we desire for the risks that we're going to have to take? And as part of this implementation, we will look to active strategies, passive strategies, and derivatives to be able to reflect these asset allocation views. So next slide, please. I mentioned that we want to manage risk in this portfolio to be able to generate a smoother return through time. So you may have come across techniques where managers look at portfolio volatility as a signal to de-risk in terms of responding to risks in the marketplace. And we certainly look at that, and we want to be responsive to a changing volatility environment. So you can see at the bottom, mitigate downside volatility, explicitly manage vol. But I wanted to highlight for you something which I do think is a differentiator, which is that we also look at momentum at the asset class level. And the visual on the left shows why momentum is a useful tool for us when we're deciding on our positioning. Weak momentum tends to be predictive of poor returns. So if we can spot when momentum at an asset class level is starting to weaken, then we can be more targeted in terms of reducing exposures while still maintaining exposure to asset classes that we like. Next slide. So the next couple of slides that I want to talk you through is going to show you how all of this comes together in terms of the portfolio today. And you'll see some similarities with what Karen's described in terms of her views, some of the themes that Alex has talked through as well. So if we move forward, let's start on the left-hand side of the circle. So this is very much about those key macroeconomic themes that I described. So top left, let's have a discussion about the growth outlook. So we expect global growth to remain above trend through the course of 2022. But we do note this is very much at a lower level than what we've seen over the last 12 months. So we've got this decelerating growth environment, but growth still remains high. Now, from our perspective, that still is supportive of a pro-risk view. We still want to have allocations to equities in reasonable size in this portfolio, but we've got lower conviction levels than before. So we have brought risk down some. What we also see is wide valuation spreads within equity markets. Now, this is interesting. So within each sector, we would note that the cheapest stocks are quite a lot cheaper than the most expensive stocks still, even despite some of the rotation that we've seen. So one thing this says to us is actually this is a good environment for stock pickers like Alex and Caroline with his strategy to be able to generate alpha on stock selection. So we are pro-risk in terms of wanting to have allocations to equities. We think it's a good environment for active management, but there's some risks out there. So if we move down to the bottom left, Karen has highlighted some of this already. Our view on inflation has, in fairness, shifted over the last few months. We definitely believe it's going to be stickier in the first half of this year than we would have told you perhaps 6 months back. So we've got this environment where we've got stickier inflation. Central banks are having to handle that. We know that we're about to start the rates rising cycle for the Fed in the US, and we know that other central banks around the world are on the same path. So growth remains robust, but we've got an environment where the inflation risks are somewhat elevated. So again, for us, that supports that we can still have a reasonably positive view in terms of equities as we look forward, but with lower conviction levels. So again, it's about having reduced that risk. If we think about government bond exposure, we know that as rates rise, we're going to have headwinds to government bond performance. So from a global duration perspective, we've lent away from that within this portfolio. We've been underweight global duration. Now, we did take an advantage of some of the volatility that we saw back in January to add a little bit back to US duration, but we've still been underweight in terms of duration around other parts of the world. And if we think about credit, well, we've been underweight investment grade exposure through aggregate bonds for some while, but we've also recently just brought back some risk in terms of our high yield exposure. And we've been quite dynamic in doing that. So a positive growth outlook, some risks around inflation, but overall, we're still comfortable that on the top right, we've got this preference for cyclical equities in this portfolio. We can see very much there's still regional variations in terms of the growth backdrop. We're through the period where it's about reopening, and as you heard Karen describe earlier, we're now into a more normal environment where growth is going to be driven by business expenditure, by consumption, and so on. But we've got differences around the world, and we're leaning into more cyclically oriented markets. So the regions we still favor Europe ex UK. Within the US, we tilt towards US value, and in emerging markets, we're underweight emerging markets. Now, just a quick comment in terms of some of these value tilts. Our view is that as rates rise, and in particular, real yields rise, this is an environment where investors typically want to just pay a little bit less for the markets they're investing in. So we have got more support, in our view, for those regions where they're a little bit cheaper versus those that are a little bit more expensive, but still a positive view overall. Next slide. So I commented that we build the strategic framework for the portfolio over the long term, and the slide here is showing you in the middle the absolute weights of exposures within the portfolio, and you can see that the portfolio is 80% equities, well diversified, as we've discussed, 20% fixed income, again, diversified across government bond and credit exposures. On the left-hand side, versus that strategic framework, you can see where we're leaning into Europe, leaning into Japan, away from emerging markets. It does mask in the US that we're leaning into US value and away from your core large cap exposures. And on the right-hand side, if we look at the fixed income positioning, again, you can see the differences with credit exposures. High yield looks neutral here, but within that, we're underweight US, but we do have exposure to European high yield. So overall, well-diversified, flexible approach, and reflecting a reasonably positive view as we look forward, but leaning into more cyclical markets and spaces and parts of the world where we can get greater value exposure. Next slide. So it has only been a short period. It's been fantastic working with Marius and the team. Since inception, we can see that we've delivered competitive returns. Since inception, the strategy's delivered just under 18% versus that CPI plus 5% return of 11.5. So we've outperformed that return objective 3 times. It's early days, but I think the signs are good. The strategy is a total of just over 600 million in it today. So if we can move on to the summary points that I want to leave you with. So for the Diversified Growth Fund, we're very much looking for leveraging the expertise that we have within the team. We're bringing together that dedicated multi-asset research, that disciplined investment process, and the experience that we've had of managing portfolios over the last 50 years. In the portfolio itself, we're really trying to find those opportunities across markets, managing the strategy in a very flexible and dynamic manner with smoothed returns through time. We've really got our eye on that medium to long-term goal of US CPI plus 5%. And on the right-hand side, as I comment, it's a relatively short period of time, but the results so far are good, and we've delivered competitive returns. Thank you, Gugu. That's the completion of my slides.
Katie, thank you so much for that informative presentation between yourself and Marius. And I think really builds up on us having full clarity on the details that are detailed regarding STANLIB's global multi-strategy diversified global growth fund. And really speaks to a lot of things that come up on the presentation that you shared with us a moment ago. And there is a question that has come through from many of the audience members, and this one speaks specifically, as you mentioned, to the being overweight in terms of equities, and we've highlighted that they are stronger leanings towards developed markets, specifically in Europe. And there's a key question that has come through as to if there are any particular trends or themes that perhaps might make you be more attracted to emerging markets or other sectors. What considerations would have to be taken into account before exploring any investment opportunities there?
Gugu, thank you for that question. So one of the reasons we'd underweighted emerging markets in the portfolio today had been that we'd seen that weakening momentum for the asset class. But certainly there's some signs there that it could be time to start to revisit that. Now, it is still early days, but when we look at what's happening in China, we can certainly see more supportive action from the PBOC. We can see, as we talked about and Karen mentioned before, that actually China had been a little bit further on their path coming out of the pandemic. So if we look at the market overall, certainly valuations are starting to look a little bit more supportive. We have some support coming from the PBOC, but we do need to keep our eyes on the Russia and Ukraine crisis. So once we get through that volatility, I think there are some signs that we might want to revisit that part of the world. But for the time being, we're very comfortable leaning more into Europe, into value, and into Japan in this portfolio.
But we're looking forward to hearing more about that as things to evolve, and I hope between both yourself and Marius and the teams that you are able to interact with to drive out much more of this important information. We'll have to leave it there for today, Peter. We really appreciate the insight that you shared with us all the way from London, and we're well aware that this has been such an insightful and informative session, so much so that we've actually run over in providing our audience members with some detail. We really appreciate the information you've shared with us today, and we'll be sure to reach out with further questions, no doubt. Thank you so much, Katie. And not just thank you to Katie, but also thanking you two gentlemen who have joined me here today, helping us understand the two portfolios that have been launched here with robust excitement here today. And that really does paint a picture of what has been underscored throughout this afternoon's session. Collaborating, of course, leveraging the collaborative efforts between both STANLIB as well as J.P. Morgan Asset Management, ensuring that we're able to tap into the wealth of knowledge and areas of expertise between both entities, and of course making sure that as investors we are able to continue our pursuit for alpha, of course reaping the returns in terms of calculations, portfolio structures that have been taken, and making sure that they really do speak to the difference and impact we'd like to make not only in our pockets but in society at large. So very good to you both, Marius, as well as yourself, colleagues, and not forgetting many of our other speakers who have joined us today. So you might be asking yourself what to do now. Well, first and foremost, make sure that you do pursue and seek more information on both these funds, which will be made on the STANLIB website, but there will be more information shared with you through the fund fact sheets in post-event communication that will be directed to you, including in your thank you emails that you will receive. But most importantly, what we'd also like to implore you and encourage you to do is to continue to participate and interact with the STANLIB team on this new venture and, of course, partnership with J.P. Morgan Asset Management. Not only to provide us with great returns as investors, but really collaborating and expanding on the growth opportunities that can be explored, altering the face of asset management and the investment landscape, not only in South Africa, but the world over. We hope that you've thoroughly enjoyed today's conversation, much that has been shared, and of course, showing us once again that this has really been a journey. Much like the marathon that was alluded to earlier on in conversation today, whilst we've reached the finish line of this particular part of the event, this is a collaborative effort that will continue and is one that will continue to reap great rewards for all who participate actively in it. So thank you once more for joining us. We appreciate the time and of course attention that you've shared with us. And if you happen to miss any snippets throughout today's presentation, welcome you to revisit this recording back at a later date. Until then though, on behalf of STANLIB and J.P. Morgan Asset Management, and of course the team that have put together this phenomenal webinar informing you and sharing more insight with you regarding the STANLIB Global Growth Fund and the STANLIB Multi-Strategy Diversified Global Growth Fund, we really want to thank you for your participation and your questions today and strongly encourage you to be part of the narrative and the journey of providing greater investment opportunities offshore. For myself, Gugulethu Mfuphi, and the team, we wish you nothing but a profitable day going forward.